Hi everyone, this is Jason Burack. Just wanted to do a short video based on some current events, and also some of you have some questions, and also there was some listener comments and feedback about miners going bust, and also oil producers going bust. So I just wanted to go through some things here, give you a general outline of the resource producers and the commodity markets for gold, silver, and oil. Okay, well, When we're looking at mining companies as investments, this is for me personally, or we're teaching paid consulting clients how to do it. Some of the most important things to look at if you're going to actually look at buying individual mining companies and not royalty and streaming companies, which have a huge advantage, or going and buying a gold or silver mining ETF like the Sprott Gold Miners ETF, or the GDX, or the GDXJ, or the SIL, or the SILJ. Something you should do is, if you don't know how to do this, you need to learn how to do this. If you're going to buy your own stocks, in my opinion, you need to check cash on the balance sheet. So you need to see how much cash the company has. That's something that's important on the checklist. Something else is how much long-term debt. How much long-term debt does the company have? So, and when is that debt due? So if the company has $5 billion in debt and they have a good amount of cash flow, and the debt's not due for 6, 7, 8, 10 years, they're in good shape. They can ride out these low commodity prices for a while. They can, restructure their debt. They can get a new interest rate. They can renegotiate their debt or something like that. However, if the company has a lot of debt, billions of dollars or hundreds of millions, and not that much cash flow, and a lot of that debt is due in the next 6 months or next 12 months or 18 months, it's a red flag that the company then, they could potentially go bankrupt, or they could be forced to sell out the company for pennies on the dollar. So these are something you need to take into account. It's another part of a checklist is how much debt, and you look it up, on the liabilities on the balance sheet. And if you can't find out when the debt's due, you either can look in the company's PowerPoint presentation in their annual report, or you email the investor relations department or management with specific questions and ask, how much of your debt is due, so-and-so, and get some timeframes on that. The other thing is the all-in production costs. Most companies, mining companies, have been guilty of only reporting the cash costs, but whether you sell soap, or you sell burgers and fries, or hot dogs, or really any other type of business, you have selling, general, and administrative expenses. So that's SG&A. So mining companies have been guilty of reporting cash costs, not including their SG&A costs. So that includes corporate headquarters, cost of capital. Cost of capital is a separate cost, but the SG&A expense has not been included in the cash costs that miners have told investors in the market for a while, which is now they're starting to reform this. But if they're not willing, if the mining company or the oil company is not willing to give their all-in production costs, I think it's a red flag if they're not willing to tell you what they are. So I think that's something else to look at. Another thing is the burn rate. The burn rate, guys, has to do with, normally you hear it in biotech stocks or junior explorers, but the burn rate really is any company that is not profitable, that is not consistently generating free cash flow. So whether you have revenues or not, since you're not profitable, you don't have profits to reinvest in the business to cover your expenses. So your burn rate then is, whether you have revenues or not, how much money per month are you spending just to keep the lights on? So for salaries, for listing on an exchange, etc., etc. So if it's a junior mining company, a junior explorer, and they're bragging like on conference calls or in their PowerPoint presentation that they have 20 or 30 million in cash on the balance sheet, right? That, we're junior, we have 20 million in cash, or junior explorer, we have 20 million cash on the balance sheet. But you see that their burn rate is, $8 million a month. That's only going to last them, 2.5. It's only going to last not even 3 months. So if they have 20 million in cash and they have an 8 million a month burn rate, they're not going to last long. So this is something to take into account for companies that are not profitable, that are don't have any revenue, or they have revenue but not profits. So you need to know what the burn rate is if you're going to speculate on these higher risk, higher reward plays. Something else in terms of the, let me just get a swig of water here real quick. Something, let me pull up the website here. I forgot to. Anyways, though, guys, in terms of the market right now, the bankruptcies, we're starting to see, and I said this in 2013, I gave a time frame in 2013. I said it would be when I started doing interviews publicly in our podcast and for Kerry Lutz and so many other places, that it would take about 18 to 24 months of either prices flat at those prices in 2013 or lower before we started to see bankruptcies, because I was looking at the debt and the cash on the balance sheets. And, we've just gone lower, and we've gotten to the point, guys, where we're starting to see a good amount of bankruptcies now. We finally saw a pretty decent-sized mid-tier producer in Allied Nevada, gold and silver producer, go bankrupt. They couldn't raise any debt or equity at these levels. It was at penalty rates, and they couldn't raise anymore. We saw BPZ, which had a good amount of oil-producing assets and natural gas onshore and offshore in Peru. They've gone bankrupt. And, out of necessity, we are going to see mergers and acquisitions. These are not going to be normally at good valuations in most cases. So you're going to see the prudent, larger and prudent mid-tier producers like Goldcorp and Pan American Silver. You're going to see these guys that didn't drastically over-leverage their balance sheets, that kept cash, and maybe they're squeaking out a profit, but they're definitely treading water on a relative basis better than their competitors. And you're going to see these guys come in and just start either buying out, juniors or smaller producers or things like that. So we're at the stage now, guys, where mergers and acquisitions should pick up soon going forward, and we're also going to see bankruptcies for companies that can't raise debt or equity, or their board of directors is incompetent and they're refusing a buyout. So it is what it is. This is part of the bottoming process of the market here. But I saw a post from on one of our videos. I forget who posted it, but it was, why can't he was talking about 10 years ago that silver miners were easily able to produce silver at $5 an ounce, and they weren't going bankrupt. Well, 10 years ago there was a lot of different factors in the resource market than now. Number one, it was easier to raise debt and equity 10 years ago than it is now. Debt and equity are at penalty rates if you can raise them at all for many miners. The only gold company that really doesn't have any problems raising any debt or equity is Franco-Nevada, and they just issued some stock to buy another gold stream or gold royalty, and that's because they're basically the most bulletproof. They can grow without a debt, and they can grow with free cash flow, and they're diversified. They have a lot of royalties and streams all over the world from companies of different size. So in general, though, debt and equity cannot be raised, but, why can't, the question then, and I'll answer it, so I'll ask the question first and then answer it. Why can't the miners produce silver at $5 an ounce and make a profit and still survive? And the basic answer comes down to their expenses have exploded and also grades have declined, so double whammy. There's great work, and I'm taking you guys now over to SRS Rockwell Report. This is Steve St. Angelo's website, and I think he covers this probably better than anyone else. This article is about the gold mining industry. Fuel costs explode over the past decade. It's from August 4th, 2014. You can go there and read it. But basically, though, guys, even though the gasoline and diesel prices have dropped, obviously since June, they've dropped quite a lot. However, if you go and read Steve's work, and there's other articles besides just this one on his website, the bottom line is that the amount of diesel has doubled in terms of usage. So even though the price of diesel per gallon or per liter hasn't necessarily gone up a humongous amount, the volume needed to mine that 1 ounce of gold or 1 ounce of silver has gone up a lot. So basically, and I'll explain this, in the 1960s and 70s, during that gold bull market, the average gram per ton of gold deposits was, I think, around 10 to 12 grams per ton of gold. So pretty good grades. But now, guys, the average gold deposit, the average gram per ton of gold is around one gram per ton. So that, in terms of the grades, that's a 90% drop. It's more than a 90% drop. So and there has enormous ramifications for that. We have depletion in resource stocks, which other companies and other industries don't necessarily have to deal with. The depletion means that, in order to keep production flat or to grow production, they have to find new sources of resource. And it's these stupid economics textbooks that say, over the long term, the price of the commodity will always fall. Well, show me evidence over the last 10, 12, 15 years where the price of a commodity has really fallen a lot. Food prices haven't fallen a lot in the last, 15 years. The prices of metals really haven't fallen a lot. The copper price is up enormously, even though the copper price is down a lot now. But over the last, 15, 20 years, the copper price is up enormously. So and same thing with oil. There's just countless examples where, and then you add in how the global population has gone, since the 60s and 70s. I think it was 3 or 4 billion back then, and we're over 7 billion now, and we're projected to go to 8 or 9. So there's a lot of factors here for why the silver miners can't stay alive if silver went to $5 an ounce. I mean, they've cut their costs to the bone now. Maybe like Rick Rule of Sprott says that they can cut some of their management fees. Maybe they can cut some salaries of management and fire mid-level and some upper management people. But in terms of most of their other expenses, their exploration expenses, they've high-graded mines. They're not mining lower-grade ore that's higher cost. There's very little expenses most of these gold, silver, and oil producers can cut in terms of fat they can trim. Most of them have done a pretty darn good job the last 18 to 24 months to cut what they can cut without actually, shutting down the mine and putting it on care and maintenance or selling the mine for pennies to someone else. And then, if you have debt and you don't have the cash flow to pay off any of that debt, you're going to go bust anyway. So and the oil companies, they prudently hedged way better than the gold and silver miners. So the U.S. shale oil producers, a lot of them hedged a good amount of their oil production at much higher prices, but they only did it for 12 months or so, give or take, and maybe 12 to 18 months they did it for, and now they have maybe 6 to 12 months left of hedging, if that. They have under 12 months left of hedging. So the people on CNBC and Bloomberg who are going on there, excuse me, let me take another swig of water. The people who are going on Bloomberg and CNBC and saying, oil's going to 30, oil's going to 20, oil's going to 10. It's going to stay there for a long time. I completely disagree. That would be a end of the world, World War III, complete collapse, and it wouldn't be peaceful anarchy like Jeff Berwick, an anarcho-capitalist, or Murray Rothbard, anarcho-capitalist, says. We would have a very violent type of scenario. I mean, even the Saudis couldn't function at $10 a barrel oil. They would need to pay off their social programs to keep their citizens happy. So you'd be looking at governments like Venezuela, Nigeria, even a lot of OPEC producers, because the private sector definitely couldn't produce it that cheap either. And you'd be looking at tons of companies going bankrupt and failing left and right. And by the way, guys, this is all the while we're still consuming about 92 million barrels per day of oil. When people say that China's slowing down, but the International Energy Agency by the Q4 of 2015 is projecting that the oil consumption the daily oil consumption globally will go up to 94.5 million barrels. And why is that? Because Americans are, with these cheap oil prices, gas is between $2 and $2.50 a gallon in most of the United States. People are switching back to SUVs and more gas-guzzling cars. In China, the auto sales growth is still high, and people are not using debt. They're not using subprime auto loans to buy those cars. And there's actually a humongous amount of pent-up oil demand in China because everyone in China cannot go out and buy a car tomorrow. That's not what the Chinese allow. So in Beijing and Shanghai, to my knowledge, we've spoken with Dan Collins about this of the China Money Report. He's lived in China for 20 years, boots on the ground. He says there's a lottery. So in order to get a car in China or a truck in China, you have to get approval. You have to win the lottery. I don't know, maybe you have to bribe a government official there to get your car. But everyone who wants a car or truck in China is not getting one. So there's still a lot of demand. So yes, the industrial demand maybe for oil has dropped. And obviously, we've seen base metals drop a lot. And you guys know that I said in my thoughts in 2015, I said to avoid base metals except for zinc. And I still think you should. But, oil is consumed. And I think there's still long-term, out of China and India, there's still going to be a lot of demand for oil, or at least, maybe for natural gas and other hydrocarbons if they allow, switching over of other engines and stuff. But there's some reasons why we might not see as much switch over for natural gas, because there could require, trillions in energy infrastructure investments, especially in the United States, to switch, all of our gas stations to compressed natural gas stations and things like that. And there's also issues with storage tanks, how natural gas is so volatile storing it. So anyways, though, guys, I was having lunch with a money manager this past week, and, we were discussing oil a lot, and him and I were on the same page a lot, and we think that oil is probably going to have a U-shaped recovery here. Now, I know, the Citibank analysts and the other bears on Wall Street who see the chart and oil looks bad, right? They're saying oil is going to 30, oil is going to 20, oil is going to 10. Maybe in the short term it goes a little bit lower, but I think like in less than 18 months, I would be surprised if it takes more than 12 months, really. I think we're going to have a higher oil price. We're going to have the oil price go back up from between $60 and $85 to $90 a barrel, somewhere in that range again, or otherwise, the system just doesn't work. The global economy, guys, and I said this also in my thoughts in 2015, if oil is too high and if oil is too low, the global economy just doesn't work. And if the dollar is too strong or the dollar is too weak, the global economy really doesn't work either for the most part. So the dollar is getting too strong and oil is getting way too weak. And, it's just most of the people are suffering from this globally in the global economy. Let me check my notes here and make sure that I covered almost everything else I needed to cover. To add to oil's case, why I think oil is going to bottom, the rig count is down about 40% since June. Frank Curzio, who he interviewed, who has the #1 investing podcast on iTunes, he interviewed Cactus Schroeder, a 40-year oil industry veteran. I encourage you to go to Frank's website and listen to that podcast about the oil market. This guy, Cactus, says that he's never seen CapEx cuts, tens of billions of dollars in CapEx cuts, and jobs cut this quickly in his whole experience in the oil industry. So it's unprecedented. Now, in terms of the rig count, the rigs are more efficient, they can do more pad drilling, and they are getting a higher output per well, but the U.S. shale oil producers, they drilled on debt. And without those hedges, guys, once those hedges come off, they're going to be at most be able to maybe sell forward on hedging their future oil production that's not already hedged, at most maybe at $60 a barrel or $50 a barrel. So they're going to start cutting a lot of their oil production probably in the next couple quarters. So, and if the oil production does cut, guys, this shale oil revolution, it's going to go from boom to bust very, very quickly. Because there needs to be an enormous increase in drilling just to keep the United States shale oil production flat. And globally, everyone isn't doing shale oil production. The majority of the world's global oil supply now is no longer economic. And if we go much lower, guys, the Saudi production is not going to be economic. So we could see, complete collapse of the Venezuelan government. Their currency is near hyperinflation. There's food shortages of rice and beans. There's electricity shortages. This is what happens with Marxism and communism. And people will say, oh, this is not really Marxism and communism because blah, 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 blah. Well, even in Marxism and communism, the people at the top still stole. Okay? So the rules that apply to the little peons at the bottom, the equality, the rules at the top, the party members, they got American, the people in the Soviet Union, they got American goods. They got to travel. The rules didn't apply to them. And so this is still Marxism and socialism because there's not the ability for any upward mobility. There's not investment now from foreign investment in Venezuela, really, although China is, but there's not a lot of foreign investment there to, educate the workforce to invest in infrastructure, grow jobs, create value added, entrepreneurship, etc. So, this is what's happening here is where we have, an unsustainably low oil price, an unsustainably low silver price, an unsustainably low gold price. And when we look at, the bears can point to the fundamentals of the oil inventories. Actually, there's a great article. I'm just going to pull it up here in the Facebook group. I'll show you it. Robert Rapier, who you guys know we've had on many times before for podcasts, I think 3 or 4 times at least. He's like, don't drink the oil shortage Kool-Aid on Investing Daily's website. I think you should go read that article. Robert Rapier, we're going to have him back on soon. I think he's one of the top oil analysts in the whole world. We're going to ask him about that. And like I said, Frank Curzio also has a great article on oil. Is it time to be bullish on oil prices? I think you should go check that out on his website. And for the gold and silver market, guys, the gold and silver fundamentals, it just looks great. It just looks the fundamentals. We continue to see growth in solar demand. There's thousands of silver uses. India is importing more silver. The mints are selling massive amounts of silver. Now maybe people in the U.S. are panicking because the chart looks so bad, and they're starting to sell some of their silver back. But I can guarantee you, foreigners in China or India or Asia would probably be willing to buy their silver. Big props to Kuz Jansen, a bullion star. Starting in 2013, according to Kuz Jansen, China started buying more than 100% of annual global mining supply for gold. did the same thing in 2014. They're on pace again to do it in 2015. And yet we have these, really horrible numbers from the World Gold Council saying Chinese gold demand is only around 1,100 tons or something like that per year. I mean, these guys at the World Gold Council, Koos Jansen is doing it with very limited resources. I think the World Gold Council, Koos Jansen just put out an article on this. I think they have like over $30 million per year research budget. And Koos Jansen's doing it by himself. Or maybe with the help of a couple of translators in Chinese, and he's doing better research work than them. So either the people at the World Gold Council, they're either stupid or they're intentionally lying. So you can you can decide which one for yourself, which one you think. I know which one I think, but anyways though, guys, I just wanted to point out that we could start to see a good amount of bankruptcies here in the near future with miners. You want to check if you own them. You want to check some of these things I mentioned. If you don't know how to do this yourself, either you should learn how to do it yourself on your own, or you should hire someone at Wall Street for Main Street. We can do paid consulting work and teach you. Or you can go out and buy gold or silver mining ETFs then if you don't want to buy individual companies, because the ETF will survive even if one or two companies in the ETF doesn't survive. So these are some things to consider, and also why the probability we see $5 an ounce silver is extremely low, because we pulled so much silver out of the ground over the last 12 years when the grades were much higher and the costs were much lower, and those mines have had depletion, and almost all the new mines that we brought online since 2008 and 2009, they needed $20, $22, $25, $30 an ounce silver in order to be economic, and those costs have been cut to the bone at most of those mines. So many of these miners are either going to go bankrupt soon in the near future, or they're going to have to shut down the mines on care and maintenance, or they're going to have to sell their board of directors if they don't want to get sued. They're going to have to sell out the company for pennies on the dollar for shares or cash. So I think the oil market, we're starting to see some consolidation. There's rumors that Whiting Petroleum may be put up for sale soon. We're starting to see shale oil producers, because they know their hedges are coming off in less than 12 months, some of them less than 6 months. They're starting to panic about acquisitions because they know they have debt. They drilled on debt. They have a lot of debt. They use a lot of cheap debt thanks to the Fed and these aggressive bankers to drill, which was a big no-no, even though shale doesn't hit dry holes. But we're going to see a painful consolidation that long-term is going to be healthy, but these economics textbooks that are saying that over the long term, commodity prices will always fall. I don't think they understand what's really happening in reality now. So I think these theories probably basically need to be changed. Look at the facts here. I don't see any food price that has really fallen in my lifetime. I had on Frank Curzio during the week, and he was talking about Disneyland, and I didn't get a chance to bring up the story, but I actually grew up right outside like 15 minutes from Disneyland in Anaheim Hills, California. And I remember when I was little, it was like $20 or $30 for a ticket for Disneyland, and now I think it's like over $100 for a day. So it's just, I mean, the inflation and how much these costs are going up and stuff like that. Obviously, there's more value probably now because Disney reinvested in new rides and things like that, or you can buy 2 parks for 1 ticket. But, we're not in an environment where, according to the textbooks, all the prices are going to fall. Everything's, the natural resources themselves, we have depletion, we have much higher costs, lower grades, et cetera, et cetera. Well, thanks for listening to this video. The new website should be done and ready live in 14 days or less. I hope you guys are looking forward to that. I'm having a gum grafting surgery, another one, unfortunately, coming up this week. So after this week, then I'm going to take probably a couple weeks off to heal up from my gum grafting surgery before I do some more interviews. But we have a lot of exciting interviews planned going forward as we march to 1 million views on our YouTube channel and move up the ranks on iTunes towards the #1 investing podcast. Thanks again for your time, guys. Hope you enjoyed this video. If you want any more in-depth analysis or things like that about the resource stocks, Wall Street for Main Street has 3 really good investment analysts here, including myself, John Manfreda, and Mo Dawood, who know a lot about the resource industry. We've interviewed a lot of experts. We look at a lot of balance sheets and read a lot of PowerPoint presentations from companies, and we can answer your questions, or we can help you out with paid consulting and teach you how to be more professional. Anyways, guys, thank you very much for watching this video, and have a great March here. NCAA tournament's about to start. Who's filling out brackets?